Terms like top line, bottom line, EBIT, GAAP, and other terms you've heard at the office or at an earnings call may make you think that speaking about finance is a completely different language. But have no fear, I'm here to help. I want to take just a couple of minutes today to define and explain EBIT and EBITDA. And no, it's not what Porky Pig says. EBITDA is a specific financial metric that helps us understand how we're doing as a company. Let's first define it. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. What is depreciation and amortization? Well, whenever we go and buy another company or assets, we generally don't expense that investment right away. In other words, we don't take the full cost of that investment against our profit right away. Instead, we spread the cost of that asset over the time that we're going to use the asset to generate revenue, otherwise known as its useful life. Basically, depreciation and amortization are the spreading out of large costs over time. Depreciation is used for tangible assets, things like furniture and technology, equipment, cars, trucks, and anything that we can touch and feel. Amortization is used for intangible assets, things like patents or other intellectual property that we might acquire. One thing to note is that we can't directly control those expenses. We can influence them by the capital expenditures and acquisitions we make, but it's not something we manage to on a day-to-day basis. And accounting is going to figure out how to measure those costs anyway. Now that we've defined the DA, let's dive into what is EBIT. EBIT is often called operating income. It's our earnings before interest and taxes. Interest and taxes are considered non-operating expenses. They're the costs that don't impact the core operating success of our company. Operating expenses, or OPEX, includes the costs that are associated with our core operations, things like the cost of goods, production costs, our overhead support functions, and includes the depreciation and amortization costs of asset purchases we've made to run our operations. Basically, to calculate EBIT, we start with revenue and subtract costs of goods sold, overhead, otherwise known as selling, general, and administrative expenses, and any other operating expenses such as research and development that might be related to our core operations. EBIT looks at the profit we earn before we account for non-operating costs and measures the profitability or success of our core operations. Okay, so now that we understand the basic definition of these terms, let's look at how we calculate EBITDA. In short, we find EBIT, then add DA. So what do we do with that? Oftentimes, we can find EBIT or operating income right on our income statement. Then, because depreciation and amortization have already been subtracted to calculate EBIT, we're actually going to add those back so we can calculate our profit before those costs. For those familiar with some accounting or financial terms, essentially EBIT is the revenue minus the cost of goods and our operating expenses. If you're not so familiar with what these things mean, let me show you. Let's find EBIT or operating income on the income statement. Now let's find depreciation and amortization above that line. Take EBIT, add DA, and we get EBITDA. So that's not so bad. But what you may be asking yourself now is, why do I need to know this? Well, there are two basic reasons why we use EBITDA, and it demonstrates why our understanding this calculation is critical. One is that EBITDA is the profit that is impacted by you and I based on our day-to-day decisions. Take a look at a P&L, profit and loss statement. On there, you'll see a couple of things we can control or impact, like pricing and volume, in other words, revenue. We can impact our revenue by selling more of the same product, finding ways to differentiate our product to charge more, or even develop new products. Now, let's look at costs. Well, we can impact our cost of goods by negotiating prices, finding additional or even different suppliers, automating production, and finding cheaper labor, things of that nature. Then we look at our support costs, our overhead. Do we need as much office space? Can we find ways to automate finance or other support processes? Can we speed up hiring and onboarding, and so on? So EBITDA is used to measure the profit that you and I can control right now. For finance professionals, EBITDA also has another primary use, and that's projecting profitability and cash flows into the future. And even though it's not a perfect match, EBITDA is used as a proxy for our future cash flows, which we then use to estimate the value of the company. Then, that valuation is used to secure things like debt or additional investments. As you think about EBITDA, you and I are going to be responsible for making decisions that drive higher EBITDA and higher EBITDA margins. And with that, EBITDA, 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 that's all, folks.